eventually moved to the buy side and became an investment professional. And for the last 12 years or so, I've had this essentially balance between teaching and working in an investment fund.
And how do you get into teaching?
You know, I have a passion for teaching. When I was in graduate school, I became a teaching fellow for one of our classes, and it was a corporate finance class. And oddly enough, so this was public policy school, but oddly enough, the corporate finance class was the largest class. And they asked me to teach this section. And to me, it was a revelation, like this idea that if you're teaching in front of 100 students, you really need to master the content. And it was this incredible rush in terms of like needing to like deeply understand it, but also like being able to articulate it and explain it in ways that were very simple and comprehensible. And I loved it, and I knew I always would want to go back to teaching, but I didn't take the academic route. So I worked for a number of years, and all I was looking for was a segue back into teaching. And after, I think it was about 10 years, I was an investment professional focused on Asia and emerging markets in Asia. And I thought I was in the middle of not a revolution, but a transformation where Asian economies and capital markets were really developing incredibly quickly and were transforming global markets. And I thought, I could create a course here that delves into all these issues. Nobody would have thought of it as a course before, but it was a course on Asian economies and capital markets. I took, I think it was 6 months to put together a syllabus, and I pitched it to my alma mater, so Yale University, where I was an undergraduate, and to my great luck, it was accepted, and I started teaching there. And so I spent a semester teaching that course to undergrads. And then after that semester, I moved to Princeton, where I've been for the last 12 years.
And one more question in regards to your background. So you came from France, and I'm in Quebec. It's a French province in Canada. But I came here with the intention of staying. I wonder if you went to the States with the intention of staying, or maybe you had it in the back of your mind to go back to France and work there.
I'm not sure, because for me, New York was also a home. So it wasn't such a stark contrast of, Paris being home and US not being home. Like I felt at home here as well. But I think in the back of my mind, it was likely that I was going to stay, because a lot of my interests were US based, whether it was, I have this particular interest in universities, and I was much more interested in universities in the US than in France. And so that I think I was in there for the long haul.
Right. We spoke about the media a minute ago, and as I think of it, let's say I watch a movie about policemen, and there is the good guy versus the bad guy, or let's say doctors. They are always trying to do the best for society. But when I watch a movie about finance, let's say Wall Street, it's about greed and about how much can I get, and then the end of the movie, you usually finish with the bad guy getting caught. But it's not, we are not, it's not the virtues of finance that we see in the media. And to be honest, I study finance as well with the initial purpose of becoming rich. I was going to be a stockbroker or whatever, get charge tons of commission. It didn't work out for me, but that's the impression that we have. So that's why the title of your book surprised me so much. So can we go a little bit deeper into why you decided to write this book, and then if we could talk about maybe one or two bad examples of finance, and then 2 or 3 examples of virtuous finance.
Yeah. And so what brought me to looking into this was, as I mentioned, I was always interested in this concept of finance as a force for good in society. And at the same time, it's hard not to look at the finance industry and not come out with the conclusion that finance seems to swayed away from its client-serving mission and from its singular focus on supporting the real economy. It's certainly it has a fundamental function in our economy. It's a force for good in all sorts of ways, but it does seem to have slipped. And in order to understand how to help finance be more of a force for good than it is today, I thought it was a useful angle to study ethical role models, and in part because I do think that the vast majority of the industry is actually wants to do the right thing and wants to serve its customers. But I also feel that for a lot of people, it's not so much a question that they're going into finance to try to extract the value from others. It's just that they're not thoughtful about their impact on others, right? Like most people go into finance, I mean, like you mentioned doctors and police officers and so on. I think a lot of people go into finance primarily because they find it intellectually engaging and primarily because it's potentially lucrative, as opposed to when you're a doctor, you go in there primarily because you're excited about the field of medicine, but also because you really want to serve others. You don't have as much of that primary motivation in finance, I think. So when I looked at ethical role models, I want to frame it in the context of most of these people are not heroic in the way that doctors have been heroic during the pandemic, as nurses have been heroic, and frontline workers have been heroic in showing up to work every day and serving us. So you have to put it in its context, right? But I think it is useful for us to learn from them. And so what I did is I looked for individuals that we could relate to and learn from. And they're not altruistic, right? So I looked for individuals that were self-interested, but they managed to balance their self-interest with the collective interest, despite the enormous pressure that put by the industry and their firms to generate short-term profits, right? And that's the thing, is that there's that constant pressure to focus on the near-term profit. And so I ended up, it took me several years I did a lot of interviewing and a lot of research. In the book, I write about 60 individuals and firms. And from them, what I did is tease out patterns. What are the patterns that we see in these individuals? And these patterns form a framework of sorts of what I believe a virtuous life in finance would look like, a life where you're self-interested and you're looking to be successful, but you're also contributing to society.
Right. And can you highlight one or two of those individuals?
Sure. So there are so many of them. It's hard to pick, but let me say, and maybe I have to frame it in context that I think I forgot to answer your first question, which is what are the pillars of that framework? So maybe I can start by framing the pillars and what are the pillars? There are 4 pillars, right? And the first one is serving your customers faithfully, right? With your customers' interest in mind. And even when no one is looking, and the challenge then in the finance industry, it's often the case that no one is looking simply because finance tends to be complex. It tends to be opaque. And there's a lot of asymmetry of information and knowledge between the financial institution and the client. Often, right? That's often the case. And so there's a lot of opportunities for finance professionals to self-serve. And because there's a lot of opportunities, they're vulnerable to doing it. And I would argue it's not necessarily because they're bad people. At the same time, there are a lot of cognitive biases that basically make good people make bad decisions. And by pursuing their narrow self-interest, they're not even they're kind of oblivious to the fact that they're actually extracting value from others, right? So anyways, the first pillar is serving your customers faithfully. The second pillar is critical in my mind because that's the area in finance where I feel the finance industry needs to be more thoughtful about, which is there's a fundamental conundrum, and that is that you could serve your customers incredibly well and in the process be successful yourself. But you could do that by extracting value from others, right? So the simplest example is as an investment professional, you invest in a company that's highly polluting, right? And the company generates a lot of profits because it hasn't upgraded its equipment, perhaps for equipment that's less polluting. And so here you have a situation where its profits are higher than they should be because the cost of the pollution is borne by society. But you're benefiting from their higher profit margin, and that's unfair, right?
Externalities.
So here you have negative externalities, and so there's that notion of being more mindful of what are the externalities, what are the indirect consequences of your decision. So that's the second pillar. The third pillar is looking inside the organization. So it's less important because your constituency is smaller, because now you're talking about your colleagues, but it's treating your colleagues and your employees with dignity, helping them develop, and also importantly, promoting diversity within your firm and within the industry, right? That's critical because, at the very end of the spectrum, you could have a finance professional that's very successful at serving their customers and one that's actually mindful of their impact on society, but maybe they're tyrants at work and they hog all the credit and manipulate others. And, there are all sorts of terrible things that can happen in a firm where they create a terrible culture. That's less important than the first two pillars, but it matters because it's, if you're going to contribute to society, your colleagues are, it is a constituency. And then finally, the fourth pillar, and that's the one that in some ways I find the most interesting, is are you using your skill set as a finance professional and the network that you've developed as a finance professional to contribute to society outside of your job? So maybe it's in parallel to your job. Maybe it's after you retire from the finance industry that you do something where you use that skill set, right? So that's the fourth pillar. You asked me like examples. I'll give you an example because this is a Canadian-based podcast. I'll give you a Canadian example, and those are it's not surprising that you would have Canadian examples because my sense is that the Canadian culture tends to think more about community and about impact on society than US culture. And there have been some interesting studies on this, right? But I'll give you the example of Erin Goddard. And Erin Goddard fits that fourth pillar particularly well. She is an accountant from Toronto. So she was at Ernst & Young in Toronto. She's very young. I met her, I connected with her, I think it was 3 years ago, and she was probably just 28 then. And she had spent 5 years as an accountant in Toronto, and she took a summer off, sponsored by Ernst & Young, to go to Kigali in Rwanda and to volunteer there. And she came back with this deep insight, which is that in a developing economy like Rwanda, there's a huge obstacle to development, which is the lack of accounting skills. When you think of development, you don't necessarily think of accounting skills as something that would be, like particularly important. But as an accountant, she noticed very quickly that there is such a dearth of accounts. There are so few accounts in the country that many of their companies just don't have tight numbers. They don't know exactly what their numbers are. And when you have loose numbers, it's impossible to manage companies well, right? You're kind of managing in the dark. And she thought, well, here I could make a huge difference. She went back and full time, and she decided to set up an accounting academy. And so
Wow.
you fast forward to today, and she's set up an academy that trains about 100 cohorts of about 100 students. So these are young graduates. And over a 13-week period, she makes them job ready. So they're not CPAs at this point, but they're job ready to work in accounting. And so she's doing two things. One is she's creating more accounting skills to go into Rwandan companies, but also Rwandan not-for-profits. And she's also like creating this group, helping these groups of people become or get into the middle class, right? The upper middle class, because now they have a professional skill set. So that's an example of a finance professional that used their skill set to contribute to society outside of her job, because that, she left Princeton young to do that. And
Wow.
there are many other examples, of course, and I'm happy to talk about more.
Wow, that's an amazing example. I'll tell you who is my finance hero, if that exists. My
Yeah,
superhero is Jack Bogle.
yeah.
And then I have a super villain as well, which was Bernie Madoff. So,
Yeah, yeah. Well, Jack Bogle, if I may, I'd love to say a word about him. It was my immense privilege that Jack Bogle participated in my fall seminar for many years at Princeton, because I created this ethics and finance course. And when I created it, after this student came to me and said, "Why don't we talk about ethical role models?" I thought, okay, well, as part of the course, let me make one part of the course about giving the students exposure to role models. And I reached out to Jack Bogle and never met him, didn't have any introduction whatsoever. And he responded right away and he said, yes, I'd love to. Of course, I was tremendously helped by the fact that he went to Princeton, he loved the institution. And for 7 years, he came to the seminar and was an anchor of our seminar. And I would argue that nobody's created more social value in finance in the last few decades than Jack Bogle, because he's basically influenced people. He's convinced a lot of people to move from active management, so putting their savings from active management to passive management, which creates a lot of value for them, because the research has shown basically since the early 1970s that they destroy value by putting their money into active management. And secondly, he put an enormous amount of pressure on the entire asset management industry to reduce their fees. So
they
he's
call it
had
the
enormous
Vanguard
impact.
effect.
Yeah, so he founded Vanguard in 1974, and that's had an enormous impact on the industry as a whole. And the only question mark is, why is it that it took 40 years for that idea to catch fire? Because it's really over the last few years, maybe the last 10 years, that you've seen this massive shift. It should have happened a long time ago, but it's happened, and now it's huge.
Well, one of the things that bothered me about finance, and as I told you, I used to be a financial advisor, and one of the things that bothers me was the opacity that a client didn't know at the end of the day how much he or she was paying for financial service, because it's baked into the price of the
Yeah,
securities that they're holding. So many of the people that I went to see, they actually thought that their financial advisor, whoever it was, the commission base, was working for them for free out of the goodness of their heart, and they
yeah,
didn't know that they were paying huge fees, and
right.
those fees were invisible to them, because it
Yeah,
doesn't there is not a line item that says fees, I don't know, 2%. It's just baked
yeah,
into the price. So this is one of the things that really bothers me about the way that the industry continues keeping this a secret or opaque, and only through the fine print or taking a finance course you get to find out about
sure.
these
Yeah.
practices.
But now I think it's if you want to be optimistic, or look at the bright side, you would say, well, because of Vanguard, because of what other firms, that BlackRock, State Street, that are introducing all these very, very low cost ETFs and passively managed funds. It's becoming much and much harder now to do that because people are tuned into this issue, and these fees have gone down dramatically. And so it's much harder now for asset management firms to get away with charging these huge fees without disclosing them or putting them in the fine print. And that's great.
Okay, I have a question now for you. Outside of the world of finance, there is an aura of mystery about hedge funds, how they operate, what goes on behind doors. I mean, the media portrays them as the black boxes, and that they are exempt from disclosing how they do business. And you work for a hedge fund, so can you give us some information? First of all, what is your role, and then can you talk in general about hedge funds, how they operate?
Sure. So first of all, for the last 10 years or so, I've been in a fund called Cornwall Capital. We're quirky. It's a quirky fund. It's a small fund, but it's primarily a family office. It's my partner's family office, and I think it's testament to his thoughtfulness that I've been able to carve out this kind of profile as dividing my time between teaching, writing, and being in the fund. But these activities are all very synergistic. We're unusual in the sense that we essentially can invest in anything, anywhere, and that is unusual in our world because most hedge funds need to have a pretty well-defined, narrow mandate. People like to allocate to very clear-cut, narrow strategies, unless they invest in a multi-strategy fund that is multi-billion-dollar fund, which has its own private equity team and its venture capital team and its global macro team. There are just 6 investment professionals at our firm, and so what I do is I focus on, so we roam around. We look for opportunities. We're very fundamental based. We tend to be long-term investors. And the DNA of the fund is private equity because a lot of the senior, my partners come from private equity. My particular focus tends to be Asia, just because that's a lot of my background. So for many years it was China, but over the last 7 years or so it's been Japan, just because there's a fascinating opportunity in Japan in the sense that the Abe government that came to power in early 2013 created these corporate governance reforms that are incredibly helpful to society, in my mind. And so we think we're we think it's an incredibly attractive opportunity to go in to buy stakes in listed companies and then to work with management and help them become more consistent with the corporate governance code. And we're very patient long-term holders, so we often invest in these companies where we have a 3, 4, even 5-year horizon. So that's one thing I do, but I also invest in global macro. So I will invest in currencies, or I will generate ideas linked to currencies and interest rates and so on, because that's linked to a lot of the thought process that I bring to my course on Asian economies in capital markets. And I'm also involved in venture capital and private equity. So I will say that in Canada, to bring it back to Canada, we launched a gym concept in Toronto. And so we found a great CEO who had managed a large gym chain in North America prior to that, but he had also launched gyms in Toronto. And we saw an opportunity because Toronto, for whatever reason, didn't have low-cost gyms in its core urban areas. And so we launched this concept, Hone Fitness. And so today we have 7 gyms that we operate, and that or rather our CEO operates, and we kind of provide oversight to that. Unfortunately, with the pandemic, it's been rough going, but we're hanging in there. So just to give you I mean, that's an incredibly broad set of investments, and that's why I say it's highly, highly unusual in the hedge fund world, because that's not in the hedge fund world, you're long short equity, you do global macro, but you don't do all these things at the same time typically.
Okay, so all that sounds extremely sophisticated. It sounds complex. Yet a few years ago, Warren Buffett made a bet against some hedge fund or hedge funds of $1
Yeah.
million, and Warren Buffett kind of was putting his money saying that the average investor will be better off in an index fund than in
Yeah.
a hedge fund, in spite of all the talent and smarts and all the knowledge that you guys have. I mean, you look like extremely smart to me, but I don't know. I have all my money in index fund either way.
Well, look, I've all my money outside of the money that I've put in our fund. I have 100% of my money in Vanguard, right? And that's why I always advocate to my students and to anyone who asks, that's really the way to go, right? You have a balanced allocation of equities and bonds, and you do it through Vanguard, and it's hard to beat that, frankly. And you're right. Over the years, it's been harder and harder for hedge funds to outperform, and just because so much capital has gone into hedge funds, and you have a lot of I guess seemingly bright people that go into the industry, and it's become harder and harder. So,
okay, one more controversial thing about hedge fund, and then we will close it. Can you explain about the fees, the fee structure of hedge fund? Because I know in my Vanguard I just pay less than 1% expenses, and that's it. But the fees for hedge funds are a little bit more difficult to understand.
Yeah. So historically, there's no real definition to hedge funds outside of its fee structure. Right? I mean, they're private partnerships, and they tend to be nimble, and they're lightly regulated. And the reason they're lightly regulated is because access to hedge fund is constrained, and that it's only qualified investors that can invest in hedge funds. And so, at least in the US, the regulatory authorities have said, look, we're not going to regulate it except to say people that are qualified, meaning they have enough money that they can lose it all and we won't worry about it, can invest in them, right? Historically, the fee structure has been 2%, the 2 and 20 model, which is 2% of assets under management go into a management fee, and that's meant to only cover your operating costs, so your rent and the salaries and so on, but that's it. And then 20% historically has been the piece of profits that you would keep for yourself from the assets that you manage. So if you make a profit, you would get to keep 20%. Over the years, that fee structure has evolved in large part because hedge funds haven't performed. And now the average for the industry is probably closer to 1.5% management fees and 15% incentive fees. Now, that's a good segue to talk about one of my favorite role models I write about in the book, Andy O'Kuhn, because he's a hedge fund manager. And the reason I think he's interesting is because he created a hedge fund and said, that's not fair. That 2 and 20, or that 1.5 and 15 is not fair, because he said, okay, if you make profits in 1 year and you keep your, say, 20%, but then you make huge losses the next year, you get to keep the 20% that you made the previous year, right?
Right.
And what you have is essentially an IOU to your investor, where you say to the investor, okay, you have to go back, we have to hit our high watermark again in order to generate these incentive fees again, right? But it's often the case that investors lose patience, and once you've underperformed and make losses, they'll just redeem and get out of your fund. And net, you look at your history, and you've basically taken a lot more than 20% of profits, because you've over the whole time period you've had losses, but you never clawed back the 20% of profits that you had in previous years. And so Andy O'Kuhn is a hedge fund manager who created Watermark with one of his co-founders, Stephen Maslowski. And they said, you know what? Instead of taking the boilerplate fees, we're going to start with a blank sheet of paper, and we're going to write down the terms that we think are fair and make sense. And the terms that made sense was, first of all, a management fee that only covers their operating costs, right? And then secondly, an incentive fee that is symmetric in the sense that if they make a profit, they keep X% of these as incentive fee. But if they make losses, then they have to return the same X% from their own savings into the account of their investors. And that's extraordinary because you never see it. Like they're a complete outlier. Wow. Now, they did it for 20 years and then they had to stop doing it because a change in the tax code prevented them from doing it. But I was fascinated by their approach. And this is one of many different things that they did to make their terms investor friendly.
Wow, that's amazing. Okay, Jean Christophe, it's late. I'm not going to keep you any longer. So can you close by telling us one more time the name of the book and where can the readers find it, the listeners find it?
Great. Well, it's Seeking Virtue in Finance, Contributing to Society in a Conflicted Industry, Cambridge University Press, and you can find it online. I'm not even sure in Canada. In the US, it would be on Amazon and all the other Cambridge University Press website. In Canada, I'm not sure where you would find it, but presumably
it's shipped there. It's shipped here. I saw it.
Yeah. So,
Jean Christophe, merci beaucoup. C'est un plaisir de parler avec toi.
Merci beaucoup de m'avoir eu sur votre podcast.
Until next time. Thank you.
Great. Thanks so much. Bye-bye.